PDD Holdings, ticker symbol PDD, reported earnings before the bell today, and their stock was down 13%. Very ugly earnings, and we're going to talk about it. And we're going to talk about what this means for China as a whole, the consumer, and is PDD a buy right now? But before we dive in, if you could please go ahead, like and subscribe. It really, really helps me out. Now, what does PDD do? Now, PDD stands for Pinduoduo. They operate two main businesses. Outside of China, they have this Temu business. In fact, they operate it inside China as well, which is a global e-commerce marketplace. And then they also operate a social commerce platform. So this is mostly in China. In fact, this social commerce platform is only in China. Temu is outside of China. And Temu is essentially like, the Amazon, but for low-cost Chinese goods, direct from the manufacturer to your door. That's essentially what Temu is, and they produce all sorts of goods. It's almost like Alibaba, but not necessarily for wholesale. You can just buy individual items on the cheap, pretty much cheap Chinese goods. That's what they do. And then their social commerce platform is separate, but it's a significantly smaller part of the business. Ideally, this is the bulk of the business as a whole. Now, this was really interesting. PDD, or Pinduoduo, actually stands for together, more savings and more fun. It's very weird that this word is spelt the exact same, but actually means two different things. Very interesting, the Chinese language. But let's talk about why the stock was down. And it's very easy to see. The company missed on their revenue figure as well as their earnings figure compared to the analyst expectations, especially on EPS. This was, I think where a lot of the pain was felt in the stock. The analysts were expecting $2.49. The company reported $1.56. And that was on $13.1 billion of revenue. Revenue did grow 10% on a year-over-year. But the analysts were actually expecting a little bit more. They're expecting about 12% growth. So it didn't quite hit the mark on either of these. And when that happens, the stock's going to sell off. Now, the business derives revenue from two places. Online marketing services is the first one, right? So that's like Temu, and then transaction services. So now this increased 6% year over year, and online marketing services increased 15% to make up the total $13.1 billion and net 10% increase in revenue year over year. Breaking down their earnings more granularly, you could see that gross margins actually fell, and we'll get into the financials and talk about why that is the case. But, net income margins fell, and so too did free cash flow margins significantly, guys. You're looking at like 35.4% to 30% decrease. That's significant, and 40% to 25% for the free cash flow margin. And then, net income dollars also fell. Free cash flow dollars also fell. So very, very ugly stuff. This is literally a business that's contracting on a quarterly basis year over year. Definitely stuff you don't want to see as an investor. And yeah, even though the top line is growing, cost management and what's actually happening in the underlying fundamentals of the business, not looking good at all. However, their balance sheet looks very, very robust. So if the business is going to go out of business, I don't think it is the case. They have $50 billion worth of cash, $1 billion worth of debt. Now, I have heard some people say that, there is some accounting discrepancies with regards to the cash, the auditing process in China. So do take this and probably every financial metric with a grain of salt. That has always been a scar that Chinese stocks have had to wear. Just comes, just with the overall reliability of the data, the auditing process of the company as a whole. That being said, assuming these numbers are true, the balance sheet looks very, very robust, and they virtually have no debt at all. So why was this the case? Let's talk about the financials on a more granular fashion. Now, we do know that revenue is up 10.2% on the quarter, but you can see a cost of revenues, right, increased 25.2%, and that is why gross margins actually shrank. At the same time, operating expenses further exacerbated this loss. You could see operating expenses increased 37%, and it's very obvious to see why. Sales and marketing expense increased 38% from $23 million to $33 million. So sales and marketing expense increased 33%, and that was the thorn in all of this, right? So when you have cost of revenues increasing just because it becomes more expensive to make goods because of tariffs, and you have your sales and marketing expense increasing that much, right, which is your biggest operating expense, you're going to get this situation right here. Also, the fact that their sales and marketing expense increased so much and it had a minimal impact on overall revenues, that really goes to show that maybe the company isn't that great with their marketing. Maybe there was some inefficiencies. Maybe their SEO or their ads weren't optimized that great. That's a real problem for a business like this because they rely on that marketing and that marketing being efficient for that quarter. And as you can see, total operating expenses increased 37% as a result. There were some efficiencies though. SG&A did decrease and research and development came roughly in line. But when that is the case, net income is going to fall 45%. And also what compounded this figure right here was foreign exchange losses. You could see here that foreign exchange had an impact on the business overall. And it really hurts when you have figures like this on only 10% revenue growth. And that is why, you saw net income fall 45% and earnings per share miss substantially. And, that really goes to show that maybe the company's AI strategy is simply not that great. Maybe their moat isn't as wide. And these are the questions you should be asking. If you are an investor in PDD, you need to be asking about their moat and really going deeper into their sales and marketing expense. I mean, the management team didn't provide a lot of color with regards to why that ballooned out. In fact, the earnings call was very lackluster in my opinion. And again, that just goes to show that when things go out of hand, management aren't really accountable. A bit of a red flag in this name. But where does it leave us with valuation? And Chinese stocks as a whole, we all know this, are very, very cheap. It's the EV to EBITDA. The stock trades at 8.1 times, a PE of 11. So, very, very cheap if you ask me. And these are the last 12-month ratios. I'm sure if you look at next 12 months, the stock's probably trading at a 10 times or 9 times price to earnings. A shareholder yield of 0%. If we look at our framework for valuations and the returns we can expect, if we plug in the trailing 12-month revenue, right, and assume a 10% growth on 40% free cash flow margins. Now, current free cash flow margins are closer to 50%, but I'm assuming because of what we saw, that will continue. And I'm looking for about a 40% free cash flow margin in 2029. So still a very profitable business, don't get me wrong. So that means you're looking at $35 billion in free cash flow in about 5 years from now. If we apply a 10 times EV to free cash flow multiple, it's currently 11. So we're actually looking for some multiple contraction, right? We then get the enterprise value, subtract the net debt, and then you get the equity value and divide by shares outstanding. The 2029 stock price should be $252, right? Very, very good stuff right there. The current stock price is $102. So you're looking at about 19% upside from where we are today, and a fair value of about 143. The stock trades at about $102. So it's about 43% under fair, or it's about 30% under its fair value. So when you look at all of this, the stock looks like a buy right now, but there's some serious questions that you want to be asking management, and you want to be doing deeper research into their marketing expense, their audited financials, the management team. Just because growth has decelerated significantly over the years, and that could mean, the overall revenue trajectory over the next 5 years might look a lot different, and maybe 10% is a bit too bullish. And then, this fair value estimate will come down in a significant way. But at a 10 times EV to free cash flow, where the S&P 500 trades at about 17 times on average, you are getting a significant discount for a company that, just put up double-digit revenue growth in the quarter. Earnings are a little bit different, but double-digit revenue growth nonetheless. On a technical basis, it looks like it's in the spot to buy. You could see on multiple occasions when we got to this 93, mid-90s area, the stock bounced, in a very significant way. Here in 2024 at the start, late 2024, and after Liberation Day, the stock did bounce significantly off this $93 area right here. So if you're looking to get into this name, I would probably, give it a week, give it 2 weeks or so, let the stock sort of base up, find an area of support. And if, the technicals are supporting a support zone here, sort of in this $90 to $100 zone, I would then probably go ahead and probably take a position, look to close this gap. The stock looks very attractive on a valuation framework. It looks very attractive on a technical framework. This is definitely a place where you want to be a buyer of PDD for the stock to maybe rip onwards and upwards, but manage risk accordingly, guys, because the market clearly didn't like the overall move we saw today. You could see down 13%, very, very ugly stuff. But yes, do I think PDD is a buy right now? Yes. However, there is that China risk, and I don't really hold Chinese stocks in my portfolio. But looking at everything, assuming everything is 100% correct, true, and real, PDD is a buy right now, especially after those earnings. It looks like we could be near the bottom. And if you miss that Liberation Day sell-off, this is probably the place where you can maybe generate some alpha for the rest of 2025. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.